For more on Zynga, we are joined this hour by Senior Vice President and Portfolio Manager for Legg Mason, Robert Hagstrom, up here from Philadelphia, my hometown. Robert manages about $2 billion in assets under management. Of course, Dominic here as well. I want to talk first, Robert, about Zynga, because you passed on participating in this deal. Why?
Yeah, it's not a reflection on the company. We basically have a portfolio already populated with some aggressive type stocks. We've been very active in the IPO market, so it was just a question of a fit for the portfolio, and at this time it just wasn't a good fit, but not a reflection on the company.
Okay, because you are in Groupon, in Jive, and some of the other recent IPOs. So what made you go in those?
Well, I think the way in which we think about where the opportunity, the total addressable market, is much, much higher in something like a Groupon. Something in Jive could be $25, $30, $40 billion addressable market. Those are the kind of markets that we're attracted to.
Well, those are aggressive companies that you're talking about in terms of stocks here. Now, how much does that make up in your total portfolio here?
I appreciate you letting me sign in on this. Is that it's a small part of the portfolio. We're talking about 2-3% type positions. The total aggressive position may be 5 to 10% the total portfolio, offset with some very conservative multinational companies like Pepsi and Philip Morris. So it allows us to take that volatility because we have good balance in the portfolio with the big blue chip multinationals.
But would you hold off, let's say, Robert, on investing in a Zynga because maybe perhaps later on you're looking at a Facebook IPO, right?
Could be. You never know what the opportunities are going to be and how the portfolio changes. I think it's a very exciting. The IPO market's very, very exciting, and the prices are changing. Even after they come public, we're seeing volatility in the prices, which may give you an opportunity to come into the stock at a later time.
Well, if you're a big money manager like yourself here, what exactly, when you go through a prospectus, when you hear the roadshow from these IPOs, what exactly makes you want to invest in, say, a Jive or a Groupon as opposed to a Zynga or somebody else?
Once again, we're looking at the total addressable market. I mean, it's kind of hard for us to understand maybe how big Zynga could actually be. What is that total market on a global basis? How big can that be? When we think about Jive and Groupon, when we think about Groupon being kind of an ad market, marketing, yellow pages, however you want to frame it, it's a very big global type market that could be billions and billions of dollars. That's the kind of exciting type market that we want to be in. And then we want to be with the leaders. We want to be with the people that are dominating that particular market.
What do you mean addressable market?
Well, it's basically just a term about how do you think this market could grow, what could be the size, what is the potentiality of the size of the markets. We want big markets, and then we want fast-growing, innovative companies that are going into that market to be the leaders. That's who we want to attach our wagon to.
Okay, but Groupon, though, I mean, some are saying that it's a very low bar. Let's say take a Groupon to get into the daily deals business. So how do you know that Groupon is going to maintain its market share?
Well, you know, when we bought Amazon back in the early 2003 period, and I remember everybody saying, you know, the barriers to entry for something like Amazon is very low. The barriers are very low, but the barriers to success are very high. So what you want is you want a proven leader that's already out there, that has demonstrated they know how to do this business, they're successful, they've got big market share. That's who you want to be involved with when you have a big market opportunity.
What do you make of these predictions?
Well, you know, it's kind of easy to kind of think about the worst case possible. If U.S. goes bad, if Europe goes bad, if China goes bad, it's going to be bad.
Right.
But the question is, will they go bad? And what is the stats to back it up? Well, I think we've got very negative narratives going on in the marketplace. Now you're hearing about a hard landing in China. I'm trying to think to myself, how do you get a hard landing in China if we're already at 8% growth coming down? That would be a huge calamity to happen in China.
Well,
I don't know how we get there.
But they're talking about a pop in the property bubble there and a takedown in the financial system.
Here again, it's important to align statistics with narratives. So it's very easy to tell stories about what's going on. Let's look at the stats. The stats would tell you it's a two-tier market in the real estate market. Yes, there is some bubble-like prices in the residential market for private investors, but remember there's another side of the real estate market, which is the social housing market of the government. That's not the bubble. That is the government investing in social housing for the people that are migrating to the Gold Coast. That's not a bubble.
Well, let's talk a little bit about some of these plays, though. If they are going to pick stocks, it's fairly universal. They want to be defensive here. What are some of the big names that you've been looking at in terms of being defensive, maybe a dividend-paying type stock?
Well, I think, you know, it's clear to me that the U.S. multinational stocks are probably the cheapest asset, maybe even globally the cheapest assets. When you look at things like Philip Morris, Pepsi, Procter & Gamble, Johnson & Johnson, we can go on and on and on. You know, great AA, AAA rated companies with dividend yields between 3 and 4%, yet they're unloved. It just makes no sense to us whatsoever. These are great companies that are going to do extremely well in a global environment, whether the environment is slow growing or fast growing, they're going to do extremely well.
But if you're going to be a bit of a bull going into 2012. Are you going to be putting more money in the financials then?
Yeah, well, as a growth portfolio manager, I would tell you I think financials are undervalued. Particularly, I think the U.S. financials are undervalued.
No doubt about it.
But I think for a growth portfolio manager, what we're trying to understand is where is that growth going to come from? I think there's a little bit too much capacity in the system. We're going to have to burn that capacity off. You're beginning to see that in the announced layoffs. You're beginning to see that in bank closures that you're seeing in neighborhoods. So I think they're telling us right now that there's too much capacity that's been built up over the last 20 years. Demand's not there, so we're going to have to seep it down a little bit. But overall, the valuations do look very attractive for value-type investors.
Will you ever buy bank stocks because they're dividend yielders anymore, or is that going to be years before?
For us, it's got to be a growth story. Everybody has their own mandates. Ours is a mandate. So we have to really be comfortable that they are going to be able to grow top line, and we want to grow revenues, we want to grow deposits and things of that nature. Most of those companies, financial companies, are more overseas than they are here U.S. domestic.
Yeah, I know you have some global stocks
Sure.
In your portfolio. I mean, is there anything in Europe that's attractive for you right now?
Well, the consumer staples, the big multinational consumer staples, look to be very attractive over there. So I mean, we have great multinationals here in the U.S. like Philip Morris, but there's many over there, Unilever, Nestle, and others that can do very well, Heineken that can do very well, that are not going to be so sensitive to the economic swings that are inevitable there.
We're talking about Europe.
Yes.
And, the wild card in 2012. Without Europe, you think the markets are going to go higher, right?
Oh yeah, I think if you just think about United States and China and say what do you think, I think the markets go much higher. Europe is definitely the card. I had a colleague that emailed me last night and said, "Don't be Panglossian about Europe." Yeah, I did too. I had to go Panglossian. I had to look it up. And it's actually it's a tutor in a play, the Voltaire's Candida, who was always optimistic. And I think the tendency is we want to be optimistic about Europe. We think everything's going to be fine. I do too, but there are going to be bumps along the way. And I think we better be prepared for them. It may give us opportunity, but if we have a longer horizon, I think we'll get through it and we'll be just fine.
But from a trading relationship standpoint, we've been talking about this idea that the U.S. is starting to maybe differentiate itself, we'll put it that way, from the rest of the world here. Do you expect that to continue?
Well, you have to be very impressed, Dominic, with the economic news. It wasn't 2 months ago that we had a GDP number that was probably going into the 2s, and now we've got one that's heading to 4. Yeah. So all of a sudden, the last 6 weeks, the economics in the United States have been very, very impressive. That's going to help the market a lot.
Yeah. All right, Robert, great to have you here this hour. Robert Hagstrom from Legg Mason.